Hey, it's Darren with Arbitrage Trade. It is time once again for Deep Dive with Daniel. And this week, his blog post, which is what we always talk about, is QE versus QT, or QT, the hidden forces driving market booms and bust. So let's break down this. First of all, let's explain what QE and QT is by definition, and then we'll get into the goods about it. And I assume QT is not something you stick in your ear. Go ahead, Daniel.
No, so I think it's before we dive into what each of these are, I think it's important for investors, traders to remember that while markets are priced at their future value or current value, depending on where market cycles are, is that markets are actually in large part a function of liquidity, and this liquidity is often driven by how central banks control the flow of money, whether they want a lot of money flowing or a little bit of money flowing to kind of control how economic, function and indicators are going. So that's kind of where quantitative easing and quantitative tightening play their parts. So the definition of quantitative easing is when central banks buy large amount of government bonds and other financial assets to inject liquidity into the economy, right? So you can think of it as they're saying, hey, like, we'll buy what you have, take our money, and then they want investors to take that money and go out and, buy more risk assets like stocks, right? So they buy back the safe bonds, they give you the money, and you go buy stocks or whatever to put it in the economy to kind of like stimulate things. So when times are tough, they do that to stimulate. And then quantitative tightening is where the Fed lets bonds mature or actively sells them in the market to bring liquidity in, so to bring the dollars back so that there's less dollars in the system to make things less liquid, so that there's less buying of stocks to go up. People are more often buying bonds because they're viewed as a safer asset. And this is typically happening when things get a little bit overheated in the market, depending on what economic indicators you're looking at.
Yeah, so the QE, I think of basically, you even brought up COVID, that situation when the Congress basically gave all of our future dollars to the banks to pump into the market, and then we had the reverse repo situation. It went up to record levels, and then we had the bank term funding program. I mean, we had so many things that were basically they were just giving cheap or free money out to these banks to basically go crazy with. And I think of that as quantitative easing. And then the tightening is what we're supposedly doing now, taking down the books. It's what's on the books, basically, in quotes. And to say, no, just kidding. We really need to pull back now because inflation hit the reported number of 9%, but I think it was more than that. Um, by the way, this is an aside. They just admitted again that the jobs numbers were incorrect for the last year again. So that's 2 years in a row, almost 800,000 difference. But I mean that the only reason I bring that up is
Wow.
because it's all the only reason I bring that up is because of it's it's funny because the numbers that they say are out there. I don't know. Even when it comes to this quantitative tightening and even the reports that are even put out there. But you know me, I'm all the way on the other side of that. So let's get back into what we're talking about, though. So in tightening, stocks are supposed to struggle, and in easing, they're supposed to basically, and they did get pumped up. So right now, we're having a weird thing that it's supposedly tightening, but stocks are moving up freely. So what's that about? Was there just so much money out there and so much cash out there that was put out there before that it doesn't matter if they tighten for another 8 years, it's going to stay that stocks are going to be great? I mean, kind of give me your opinion on that.
Yeah, so I think it is in large part due to how much liquidity was pumped into the market, right? So you got to remember from when we had the first COVID stimulus under Trump, and then the Inflation Reduction Act under Biden, which is really the second COVID stimulus, which just doubled what we did before, you had a third of all US dollars ever printed put into the system, right?
Yeah,
So
crazy,
that's like
crazy.
if your shower head became one third more powerful, like out of nowhere, right?
Right?
You would really feel it, right? So
Yeah.
when you have that much money put in the system chasing so few assets, well, it still has to be somewhere. So because sure, like the Fed raised rates and they did it quite drastically, but like the risk in the system was still there. So people weren't really willing to buy the bonds in the way they normally had. And especially when you have things like the yen carry trade, where you can, oh, well, now it's expensive to buy dollars in the US, but I still have the dollars. So now I can just go somewhere else, borrow in that other currency at near zero yield. So it costs them next to nothing with the money they already have
Sweden?
as collateral. So they get extra. So it
Yeah.
just creates more liquidity in the system, right? So I think it is a combination of there was so much before, and then stocks went up so much with that liquidity that it created like the snowball effect of, kind of perceived how much money was in the system. And I mean, even you see it now, how quickly we've come back from what was, the lows at the beginning of the month. And we're already back near the all-time highs from the beginning of the year. And so, I think, you had it right. There's just so much money in the system that even though we did some tightening, it clearly wasn't enough because we've seen earnings come through at least for this quarter, and you know they're not spectacular, but they're not bad. Maybe there's some indication of potential slowed growth in the future, but at least as the numbers report it, and a lot of the Fed numbers show, like it's just not quite bad yet. So it's like there's no reason for any easing, and I will agree with Trump that I think Powell's always late, so he can't tighten because it's also like it's not spectacular either. So it's kind of at this like stalemate area.
Yeah, 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 stale and or stagnant area. Yeah, it's funny you
But
use
still a
the,
little bit of inflation. One might say
yeah,
stagflation.
that's right. So it's funny you use the term, or you use the, analogy of a shower head because, um, just it was what's funny is they're saying this market is ripping people's faces off, and that's what would happen if you really intensified your shower head. It might rip your face off. Anyway, I just thought that was kind of fun. Um, the, really, I mean, let's just talk about investors and what they should do during these times when, I guess, right now we're tightening, um, and it might be a while till we ease. So, what if this is not advice, but what would the experts say?
Yeah, so I mean, I think it kind of creates like a tricky situation because, at least if they're going to tighten, then you need to realize that bond yields are going to go down, right? So what does it mean when bond yields go down? Is that
Which, by the
bond
way, the 30,
prices
I just gonna say, by
go
the way,
ahead.
the 30-year topped over 5 and then pulled back within the last 24 hours. Go ahead.
Yeah, so um, that is actually because I was reading about this that the market is pricing in that there was a potential, I believe, 8 cuts they were expecting this year, and
Right,
now they've
right.
reduced it to 4, right? So they've become so dovish on like what the Fed will do that their rates are trading much higher because they don't really think they're going to do much to
Mhm.
them. But with that, as if the Fed were to cut rates to continue, or sorry, to if they were to cut rates, bond yields would rise, right? So that's something that could happen. It's kind of this tricky situation where when they do cut, though, as we know historically, that is typically when there starts to be some market turmoil. And with the recent volatility in the market, you definitely, it's not asymmetric one way. So I think you need to kind of be weary of all risk to the downside, and ironically, risk to the upside too, of getting caught going to the upside when there's still more potential downside. So it's kind of this tricky situation where I don't really know what to do. Luckily, you know, we do have our arbitrage trading system, so you can go look at the bands, see where these positions sit, and just from a technical perspective, manage your portfolio from that. Our founder Royce does a weekly webinar, kind of assessing a lot of these things. So as markets develop, you can definitely go check those out.
Yeah, and in our last after the bell, which I did a little outtake of, Royce actually predicted this bull run, this little mini bull run we've had over the last week or so. So it's those bands work. That you don't have to think about it. That's what it's like, trade while you sleep. You can literally do
Oh
that and
yeah.
not have to worry about it. So that's, we do pump our own, or we do, toot our own horn here every now and then about, the product that we do have out there. Okay, this is great, and pretty much right now we're in a weird situation. It's a V-shaped recovery, so we don't know what's gonna happen there, so we don't know how the Fed's gonna react, so we don't know when QT is going to stop and we go to QE. So there's just a whole lot of unknowns, and that's why I've heard you say over and over again, don't use one thing as your go-to as an indicator, and that would include QE and QT, but use everything. And if you just don't want to use anything, then just use our algos and let it do all the hard work, right?
Hmm.
All right. All right. Appreciate it, Daniel. I look forward to seeing what you got for us next week pretty soon. I guess we can go ahead and tease it. We're gonna run through actually our founder Royce's book that he pretty much it's like a textbook on how to trade and his experience and his algorithm that he created, all that good stuff. And we're basically just gonna do a walkthrough and read chapters and then talk about it here. So I guess you could say it's one of the best educational series slash deep dives that we're ever going to have here. So I look forward to that.
And if you want to get even deeper, you can buy the book.
There you go. That's right. Yeah, I guess we probably should flash that up in the future and talk about the link to that too. So, yep, good to see you, Daniel. I guess it's time for you to go to sleep while I am just getting started with my Red Bull, and I will talk to you later. Have a good weekend.
I've lived the day, Darren, and I can tell you it's going to be a great day for you.
Thank you, Psychic from overseas. I'll go bet on whatever you say. All right, take care, Daniel. Have a good one.
Bye, Darren.